Well, income statement or profit and loss statement is the statement of the business operations, income and expenses over the year. Well, to start off, there are three major statements by which we can study a company. They are income, balance sheet, and cash flow. Well, these three statements are the statements that are published and that give the picture of the company. Now we start with income statement. Income statement is prepared for a period and includes revenue and expenses over that period. Now, mostly companies employ accrual method of accounting. That means income and expenses are accounted when they happen rather than when the cash is received. So if sales happens today and cash is received in like 30 days, the revenue will be recorded today. The first item in income statement would be your revenue. Revenue can be divided into sales and other activities. Sales will be the majority part of the revenue, and some part might be left to other activities. Corresponding to this sales, there is direct cost in terms of cost of goods sold. That would mean the cost of raw materials. Now, revenue minus cost of goods sold gives you the gross profit margin. This is known as top line. Actually, revenue is known as top line and revenue growth is known as top line growth. And this will be the gross margin. Now, this actually means that, for example, if a particular item is sold for 100 rupees and the cost of the product's input is around 20 and your margin is 80. Actually, gross profit margin will be upon cost of goods sold, and 1 minus 2 will be gross profit. And 1 minus 2. So these are the terms that are associated with seeing the performance of the first level of business, that is revenue, sales and the loss, sales and the costs associated with the sales. The next level is operating expenses. Now, operating expenses would require your selling, administrative, general expenses, labor costs, all of these. So here we are building the income statement. This is first, this is second. Now all of the operating expenses would include rent, utilities, salaries, interest expense, etc. Now a business has to occur these expenses as well, and it's not limited to cost of goods sold. Therefore the third line is your operating expenses, or we can put SG&A, selling general and administrative expense, and remove the interest expense part from here. Now revenue minus cost of goods sold minus SG&A will give you EBITDA. This is frequently used in the calculation of enterprise value and understanding of the functioning of the company. It defines earnings before interest, tax, depreciation and amortization. Now the next thing is depreciation. Depreciation practically means if an asset was bought at 100 in year 1, then the value in year 2 would not be 100, it will be 80, and the depreciation expense will be 20. This was what in year 0, this was in year 1. This is effectively the time, this is the expense split over, depreciation splits the expense over time period, so that it's not only in the last year that it becomes 0, but it gives a way to depreciate, which can be straight line, double declining method or other methods of depreciation. Now if we multiply, if we subtract EBITDA, depreciation from EBITDA, we get EBIT. EBIT is also known as operating income. Now EBIT upon revenue will give you operating operating profit margin. This is known as operating income or operating profit. Now the other measure is, as we can understand, it's EBIT, that is earnings before interest and tax, so interest. Now if we subtract interest from EBIT, it is profit before tax. So the profit before tax, if we have to calculate the margin, it will be PBT upon revenue. And the last item, as we can understand, is tax. After tax, we subtract PBT, tax from PBT, it gives you PAT, and the final is your bottom line, which is your net profit margin. That can also be net income. And this is a way in which your income statement is measured. We start with revenue, that is your cash inflow, and then we put all the other operating expenses. Then we put the non-operating expenses, that would include your interest expense. And then finally we put the tax rate to calculate your net income, that is the income that the company will take as profit for the year, can distribute as dividend or retain as retained earnings. Now this net income is related to cash flow, and all this is how it is, the cash flow is calculated, cash flow statement is calculated. We will start with it later. Thank you.